Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be, as usual, kicking off with the major equity indices, highlighting some of those key levels, especially as equities start to pull back here, but maintaining bullish structure. This does indicate potential buying opportunities. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today. It's actually just the one. And we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500, and we have seen this pullback ever since price touched that 460 area. Price is now at that area between the 21 and the 55-day exponential moving average. And also at 444, sorry about that, at 444, you can see that was a previous area of resistance before earnings season kicked off. Earnings season got to a good start and we saw that breakout. However, price is now pulling back to that level and is actually bouncing higher from that level based on the last 2 days of price action. However, index futures are showing that price could open a good bit lower this morning, back at that area once again. So the big question is, can this level hold as support? If it does not, the next key level that we're looking at would actually be the 55-day exponential moving average. And below that, you have around 431 as another potential support level. So that's quite a bit of a decline if price breaks below that 55-day EMA. But for now, that level is holding. Let's see how things play out in the next few days, because this week we do have retail earnings that could act as a catalyst for a move higher, especially because retail earnings give a good indication as to consumer spending. And consumer spending, has been unusually high despite high interest rates. So we could see, retail earnings actually prove to be an upside catalyst. But again, if retail earnings goes badly, we could see that breakdown below 444 and a continuation lower. That being said, the bullish structure still remains. However, we have definitely seen a decline in momentum. The 50-period CCI approaching that zero mark here when it was at above 200 in early June. So that decline in momentum, followed by this pullback, even though price is still in a bullish structure, we may not get to see the same veracity of this rally that we saw earlier in the year. Moving forward, even if price does continue to move higher. So if we do see price continue to move higher, it may be more of a grind higher as opposed to a very sharp move higher. Regarding interest rates, the next two meetings, we have 3 meetings left for the year, and the next 2 meetings, in September and November, we do expect to see the Fed keep interest rates as is. But the big question is actually the December meeting. Will they cut in December, or will they leave it until January? We do largely expect to see a cut in January, but if we see a cut in December, we'll have to keep an eye on the data that comes out, inflation data and jobs data especially. And if it comes in line or better than expectations, we could see a rate cut earlier than expected, and that will act as a tailwind for equities to continue to move higher. Okay, taking a look at the NASDAQ 100. So the NASDAQ 100 is at the 55-day exponential moving average, and we have seen a bounce up higher. And even this morning, yes, it's set to open a little bit lower, but not as much as the S&P 500. And we've actually seen a slight rotation in the last couple of days, a slight rotation back into technology stocks, hence why we are seeing the NASDAQ 100 actually outperform the S&P in the last couple of days. Still in a critical area, but still maintaining a bullish structure. Price is reacting to the 380 major resistance level as seen by the reversal, but we could see a continuation high here if price can break above that 21-day exponential moving average, which is the red line. If it does break above that, a move to 380, 382 could be on the cards. But if we see a breakdown below its 55-day EMA, we're looking at around 360 to even 350 as the next key area to the downside here for the Nasdaq. Taking a look at IWM, which is the Russell 2000 ETF. So we saw the breakout and we saw a strong rally towards the 200 area, which on the weekly time frame is a major level of resistance. Since then, price has reversed, as you can see, and has actually come back, as discussed last week, to retest that 188 level. Yesterday, there was an intraday bounce from that area and a 55-day exponential moving average. So we were seeing a bullish price action as of yesterday. However, again, this morning, like equities across the board, it is set to open a little bit lower, but still above that 188 key level. So the next few days will be critical to see if price can maintain above 188. Because if it does, it still provides a good risk reward long entry point. But if it doesn't, there's actually significant room to the downside if there is a breakdown, with the next key area of support being all the way down at 180. Historically, though, when it comes to the Russell 2000, in the last couple of years, it has definitely been respecting its key fib levels. So a breakdown below the 38.2 fib level at 188 would be quite critical, actually. And I would expect to see a strong decline in price back down towards 180. Taking a look at TLT, the Treasury Bond ETF. So we saw a strong breakdown for TLT, followed by a bit of a recovery here, a retracement higher. And I was looking for probably a higher retracement back towards the 99 level for a better risk reward bearish entry point. However, we did not quite get there. Instead, we saw price struggle at around 97. Strong bearish price action and set to open even lower this morning. So it does look like price is heading towards 92, which will be the previous swing low here for TLT, and also a major area of support. And if it breaks below 92, we have around that 88 area as well. So TLT definitely under pressure, a lot of bearish price action. Momentum has recovered from an oversold condition, heavily oversold condition, and it is still very close to minus 200 on the 50-period CCI. So it is still a little bit oversold, but not nearly as much as what it was a couple of weeks ago. Overall, bearish thesis here for TLT. Right, taking a look here at the US dollar, and the US dollar has been performing quite well, especially as a safe haven currency. We know that with China, there are some concerns regarding the economy there. They have implemented additional rate cuts as well to help with that. And we also know with Russia, they had a significant interest rate hike quite recently. And due to those instabilities and essentially a bit of fear instilled in currency markets because of those two central banks, we have seen some rotation back into the dollar. So the dollar has recovered very strongly from the first week in July, where it declined very quickly towards that $100 level. And it's broken above its 21-day, 55-day exponential moving averages, also above 101 and 102 previous levels of support, which could have very well turned into resistance. We saw a nice retest of 102 and it's looking like a continuation higher back to the level that we discussed last week at 103.50, where we've immediately seen a rejection for now. But today's price action isn't that bearish just yet. So we could see some consolidation before potential breakout below 103.50. So just because price reached at 103.50 level, doesn't necessarily mean there will be a reversal lower. It just means that there could be some resistance before this continuation higher, especially with the fundamental forces and the macro forces in play that's actually supporting a bit of a somewhat stronger dollar, despite the fact that markets are pricing in a dovish Fed and markets are pricing in future interest rate cuts, which will act as a headwind for the dollar to move lower. But for now, let's see what price does at this 103.50 area. Okay, moving on to gold. So gold, moving inversely with the dollar, has continued to decline as dollar has rallied. And we've seen at the 184 level, price did run to resistance, very choppy price action, but breaking below its 21 and 55-day exponential moving averages, and it is now at a major level of support on the daily time frame. As you can see, price has found support here on 2 occasions previously this year alone. So let's see what happens if price can find support here and continue higher. But if the US dollar continues to strengthen, we could see a breakdown and a significant move back down towards that 171 area, which is the next key area of support on the daily time frame. Momentum on the weekly time frame is certainly dipping, and daily momentum as well is not oversold, but in negative territory. So it doesn't really look very positive here for gold, and my bias here would be a bit more to the bearish side. So looking at oil, and we have the light crude oil futures chart here. So oil has been very tricky in the last few weeks. Ever since the price breakout above 74, we saw a perfect retest and continuation higher. And that was in line with our thesis when we spoke about this a few weeks ago. However, once price reached this major resistance level, I was expecting a bit more of a reversal, and we're not really seeing too much of that. Yes, the last few days have been quite bearish. This morning has also been quite bearish, but it's still not giving me strong signs of that reversal just yet. And I'll need to wait until the end of the week for the weekly candle close to see where oil could potentially head to next, because we need to see price respect that 83 resistance level, and right now it's showing signs of invalidating that area, largely due to the fact that supply cuts are acting as a tailwind here to move oil prices higher. But on the other hand, we have poor Chinese data, a poor economic outlook in China that's going to impact or negatively impact oil demand, and that is going to be a longer term headwind for oil. But the shorter term supply cuts are certainly propping up price. And also, when you consider the fact that China is now cutting interest rates to increase consumer spending and increase demand, that could also act as a potential catalyst for oil to continue higher. So there's a few oil price action right now is just ambiguous, unfortunately. And I think we'll have to wait for a week or two to get a better direction as to where price will head, especially if it can respect this 83 level. If it doesn't, and if it breaks above it, the next key area would be at around 94, 95. But if it does respect it, we're looking at this range once again with the next key level at around 74. So taking a look at sector rotation, we have 7 sectors in the improving and leading categories, and we have 4 in the lagging and weakening. So in the leading category, we have discretionary. It was here for quite some time, but losing out on a lot of relative strength and momentum, heading towards the weakening category. That being said, with retail earnings this week, we could see maybe a change in this trend towards the weakening category, depending how earnings goes for these companies. Again, this has been in the leading category, so it's only natural to see that steady rotation and back into the weakening category, but very much dependent on earnings this week. Technology, strong rotation out of the leading category into the weakening category over the last few weeks. However, technology, like I said, in the last couple of days, we've seen some outperformance within the technology sector relative to the broader market. So it won't show up on this chart just yet. There's a lagging component to this chart, and it's also on the weekly time frame. But we very well could see, a pickup in momentum here for technology, and maybe see the sector rotate closer towards the leading or improving categories. Communications was underperforming a bit, but not by much. And we are actually seeing a slight pickup in momentum here. So instead of heading straight towards the lagging category, it could very well head closer towards that improving category here as we start to see investors rotate back into communications and technology. In the improving category, we have quite a few names. Energy, off the back of higher oil prices, is moving higher. And we have financials as well. Sorry about that. We have financials also providing some good relative strength and momentum. Also, no earnings to be worried about for financials. These 2 sectors could very well move into the leading category soon. Industrials on the cusp of breaking into the leading category. And we also have real estate and materials finding some momentum here. along with the rest of the sectors, including our defense sectors and healthcare, utilities, and staples, all increasing in that relative strength momentum. And I do expect to see these defensive sectors rotate into the improving category. However, when it comes to the defensive sectors, I think there's better places to be placing bullish bets on, like the sectors that are doing well in industrials, financials, energy, even some materials names are doing quite well. So yes, it's we are seeing a bit of a shift in sentiment for these defensive sectors, but I do think there's better opportunities out there if you're looking for bullish ideas. So moving on to some subsectors of interest, and again, it's just the one subsector that I have for you today, and that is the semiconductor ETF, SMH. So SMH posted this huge double top at 160 on the weekly time frame. Price did run into resistance and has been moving lower, breaking below its 21 and 55-day exponential moving averages. And SMH has been on my watch list for quite a few days because I was looking for price to reach 144. It didn't quite get there, but we were already seeing some very bullish price action, significant bullish engulfing candle, and price only set to open slightly lower this morning, which is already outperforming the broader market. So again, a lot of rotation back into technology and a lot of rotation back into semiconductors as well. This could provide a good credit spread bullish opportunity for a revisit back towards that 160 area. So a bit of a shorter term play, but it is very much dependent on the fact that we have seen significant bullish engulfing candle yesterday. So taking a look at some of the trade ideas or market observations that we've gone through over the last few weeks. General Motors. So General Motors was a bearish idea when price was at around 39.40. We saw a rejection of that $40 level, and that provided a good risk reward bearish entry point. And this trade has done very well for us, with price now at 34, approaching this 33, 32 major support area. So this is where it makes sense to take profits. I think last week I said, taking partial profits would have made sense. But now with price so close to this major support level, the bulk of the move has happened. We saw a significant bearish candle here a few days ago. I believe now is a good time to get out of this trade for a very good profit, especially with price once again very close to that oversold condition. Taking a look at a new idea for today, and that is J&J, so Johnson & Johnson. We can see price on the daily time frame form a bit of a double top here at 173, struggling to break above that 173, 174 area. And in the last 3 candles, 2 strong rejections of that area. So this provides a good risk reward bearish entry point, and I'll be targeting the 168 level. 168, 167, that was a previous area of resistance, and it also has acted as support quite recently. So this would be a good entry point here for Johnson & Johnson for a bearish move. Moving on to Tesla. So Tesla we looked at last week, and the reason we looked at Tesla was because we saw price approach 240, and the thesis for this was that price stays above 240. As you can see, price actually broke below that level, but has recovered towards yesterday. And I wouldn't say that's a complete invalidation of that level. If I see another close below this level, if price closes below the 240 area once again today, then it would be time to close out the trade. And it was a very good risk to reward entry point at the time because we had plenty of upside, but very limited downside. And if we had to lose out on this trade, it would be for minimal loss. So again, I would wait today, see if we see price close below that 240 level, and if it does, might be time to cut losses on this trade, unfortunately. But again, like I said, good risk to reward at the time, and it would be a minimal loss. So Oracle, we've seen some very similar price action to Tesla. It did break below that 115 level, but found support at its 55-day exponential moving average immediately and broke back up above 115 yesterday. Set to open a little bit lower this morning, but the bullish thesis still remains. I'm still looking for 120 as a potential take profit zone. And again, it's a good credit spread opportunity here because a credit spread does offer some downside protection or downside buffer. And it does take advantage of the fact that even if price moves in a neutral sentiment, the credit spread will still be profitable in the long run. So a bit of patience here required for Oracle, but still very much in line with our neutral to bullish thesis, and 120 would be the take profit zone. Taking a look at Zoom. So Zoom, we were bearish at 74. We saw multiple rejections off that level. And since then, it has moved very much in our favor, all the way down towards 66. So last week, I did suggest that we take partial profits on this name. And, I do think now is a good time to close the entire position because of the fact that price is struggling to break below 66 and it is finding some support there. So again, we don't want to get too greedy. There was a large move in our favor, and this trade should be quite profitable. So it makes sense now to get out of this trade and move on to the next one. So a new idea for you today is Roku. Roku, we saw break above that $79 level with a lot of momentum approaching 99. And since then, it has actually pulled back, recovered from an overbought condition, and came back to retest that 79 level. And we're already seeing some bullish price action in the last two sessions from that area, and a strong bounce yesterday. So even though it's set to open a little bit lower this morning, it still provides a good risk-reward entry point for continuation higher, but once again targeting that $99 area. And with that, that is all I have for you today. Thank you so much for joining me, and I will see you next week for another market outlook. Have a great trading week, everyone.